Good morning, everyone, and welcome to this session on your accounts rules queries. I'm Liz Rosser. I'm the Executive Director of Operations and Resources at the SRA, and I'm very pleased to introduce our expert speakers for today. So we have Sean Hankin, who is our Head of Forensic Investigation and Intelligence, Mark Adderley, who is a Senior Manager of Professional Practices at Crowe UK, and Ian Johnson, who is a member of the Institute of Chartered Accountants for England and Wales Solicitors Community Advisory Group and also a partner at Hazelwoods. So, as you know, we ran the face-to-face compliance conference a couple of weeks ago, and we had a really engaging session on the accounts rules. It was actually standing room at the end. It was a very full session. We've got a slightly different panel today to share their insights. So if you were at that, you'll get a slightly different take on things today. But most importantly, you'll get a chance to ask your questions. So to submit your questions, you should see a link underneath this video. So please do type your questions in. Don't be shy, do start to submit your questions straight away. In fact, we've already had quite a few leading up to this. We've tried to incorporate some of the sort of more common questions in the brief that I'll run through first and the questions I'll ask the panel, just to make sure we cover them, but we will also allow time for yours at the end. Please, if you can keep your questions quite general, we don't want anything too specific because that then is quite hard for us to cover in this kind of session. So before we move on to your questions, we just want to talk a little bit to set the scene, really. As I'm sure you'll be aware, the way that law firms handle client money is very much in the spotlight at the moment and has attracted a lot of attention. We all want to talk to you as well about what we're seeing on the ground, the kinds of issues we're seeing, and then, as I say, address a number of common queries before we come on to your questions. So perhaps, Sean, I could start with you. What would you like to touch on maybe as some of the sort of recent developments in this area?
Yes, thanks, Liz. Morning, everyone. So probably the thing people will most be aware of is what's happened at ICAEW, which was a firm which collapsed towards the end of last year, and the fallout from that. On the back of that, we've launched our consumer protection review, and also a consultation into what we've called client money and legal services, and how we safeguard consumers and provide redress. So with the consumer protection review, we're actually holding a separate session on this at 1:30 today. If you haven't signed up for that, though, you can catch up with it later on our YouTube channel. We've launched 3 consultations on a range of issues relating to how client money is handled and possible options for making changes in the future. It's fair to say that even if some of those changes are decided upon, they wouldn't come into effect for quite some time. So there's still plenty of client money to be looked after between now and then. We've also done some quite significant work around what we've called accumulator firms and trying to get more of an understanding about how that area works, and also published some further guidance and a warning notice on mergers and acquisitions.
Great, thanks, Sean. And in the consumer protection review, one of the issues that comes up is third-party managed accounts. There's been quite a low uptake of TPMAs at the moment. Why do you think that is? Perhaps I'll start with you, Sean.
Yes, I think there's probably a number of reasons for that. First and foremost is the lack of choice in the marketplace. We've not seen a number of providers enter into that space that we perhaps anticipated. There's a general lack of clarity and understanding of how they would work and how they would protect client money and the mechanics of them. They are, though, a big part of the consumer protection review discussions. And we are aware that that model does work in other countries, other jurisdictions. So we need to see whether it can translate to the UK legal service, the England and Wales legal service market.
Okay, thanks. And Mark, did you have anything to add on that?
Yeah, I think as Sean mentioned, there is a lack of clarity in how they work. There does seem to be a mindset thing talking to clients where they are not sure about how they would be able to implement it, where the risk would lie, and they essentially see client account as being critical to their own operation, so they don't want to pass that responsibility on to a third party. And the biggest thing talking to clients is cost as well. There's such a lack of clarity on cost, so people don't know how much a transaction would cost to put through a TPMA. I think there are a few barriers still that need to be addressed before they'll get adopted more widely.
Okay, thanks. And in terms of impact on the ground, what have you seen any?
I think there's an increased awareness that things can go wrong, but firms almost accept that and want to keep it within their own control rather than pass it off to someone else. There seems to be a curiosity as to what's gone wrong in the sector, particularly with ICAEW, and what went wrong and how they can prevent it happening to their own firms. And they're quite conscious that their own firm, it's almost the perception that their own firm isn't vulnerable to the same sort of thing that happened at ICAEW, because they don't know what happened as it's still ongoing. They're conscious that they don't think it applies to their own firms.
Okay, thanks. Ian, in terms of the ICAEW, has there been any feedback from them on the Consumer Protection Review proposals?
Yes. There's been a lot of discussion about it, especially at the advisory group. There's been little so far feedback on the consultation because it only came out a week or so ago. But talking as a reporting accountant myself, and just based on the discussions we've been having probably over the course of the last 6 months or so, there's obviously a lot for us to get our teeth into here. I'm going to talk to you, just focus on the SRA accounts rules points specifically, because there is so much more in the consultation beyond that. But residual balances, I think we'd all welcome some more prescription over timescales. The 12-week proposal is okay in theory, but I think some recognition needs to be there that some balances aren't possible to clear in those timescales. Certainly the effort should be recognised, and so I think we want to see prescription rather than restriction over those. I don't think there's a great belief that there are that many firms that are holding on to residual balances deliberately to benefit from the interest on those balances. And I know the consultation goes into quite a lot of detail about that. There are clearly going to be some bad actors out there and some people that are doing that, but I don't think it's a firm-wide issue, certainly from the firms I've been speaking to. And firms are generally pretty good at communicating their interest policies to their clients. That they're not always the best at following them necessarily, but certainly the policies are there. Removing the ability for firms to benefit from interest income and removing that ability too quickly is going to result in some financial difficulty for a lot of firms. I don't think we can avoid that. So I think that we just need to tread really, really carefully with that one, because we don't want to pull the rug from under people's feet. PPMAs, and I know there's going to be a bit more discussion about those today, and I'm sure there's going to be a fair amount of debate. I think there needs to be a lot of understanding around TPMAs. I know a lot of firms that don't actually know what TPMA stands for, and certainly the inability for firms to benefit from client interest on TPMAs is going to hold back a lot of firms from taking that leap, certainly taking that leap too early. Accountants reports, that's another bit that's in there. The change to the regime about submission of accountants reports. Now, I'm supportive, and I'm sure a lot of reporting accountants are too, supportive of returning to the regime of submitting all reports, and I suspect Sean's going to talk a bit about that as well. I personally don't know why that was removed in the first place. It seems like the SRA were just deliberately removing some element of oversight there without there being any clear purpose. So I'm pretty supportive of that. Looking at that COFA declaration that was proposed, I don't feel that that's going to be enough of a deterrent, and I'm sure most reporting accountants would agree too. I don't feel that's enough of a deterrent for firms that don't want to get an accountant's report to actually push them to go ahead and get one. If they're not going to get an accountant's report, they're probably going to make a declaration to say that they've had one anyway. So I'm not quite sure about the effectiveness of that. I think we need to review the guidance around how and when firms can claim exemption from the need to obtain an accountant's report. I just want to make sure that firms aren't exploiting the exemptions that are there from manipulating the date of bank reconciliations, for example, to get around those thresholds. The periodic rotation of the reporting accountant, now that's in line with the requirements to rotate statutory auditors. So it's nothing new, it's nothing surprising for auditors. But I think we'd like to see a little bit more clarity around whether rotating within the same firm is allowable. And I will shut up in a second. I realise I've been going on a little bit here. The separation of the COLP and the COFA and all those other statutory posts within a firm, I think it's good, but how that's going to apply to small firms is going to be interesting to see. My final point here is the mandatory training for COFAs that was proposed, or rather the training package for COFAs that was proposed. I think that's a good idea, and I think that's going to be welcomed by a lot of reporting accountants and the ICAEW too. So I hope that answers your question.
Thanks, Ian. And I think you've given a real taster for some of the things in the Consumer Protection Review. So hopefully people will come back for that at half-1 and keep an eye on that and get involved in those consultations. So I'd like to bring it back to one of the themes that is in the CPR, but is also very much part of what we do at the moment in terms of accountants' reports. So I wonder, Sean, if you can give us a bit more detail about what's happening in this area, because it is a bit of a focus for us at the moment.
Yes, it is. I mean, first of all, to say about how important having an accountant's report is. Firms who hold client money, it's often the only check that they would have in terms of a third party coming in to look at the client account and what's happened with that. So a lot of reliance is placed on that control. We would expect to have seen, as Ian's just touched on, we only get the qualified reports submitted now through to us at the SRA. We would expect the number of those received to have reduced because we've asked the accountants to use their judgment far more and become more outcomes focused, as are the new SRA accounts rules, which came in 2019. However, we've seen the numbers reduce significantly. So to give a taste of that, we had just under 2,000 QARs submitted to us in 2016, and that's reduced to just over 500 in the last full calendar year of 2023. So it could be that more and more firms are adjusting their processes and that there are genuinely 75% less qualified reports compared to 8 years ago. However, what we are seeing on the ground, and it's mostly my teams that are seeing this as the forensic investigation teams, is that some firms aren't engaging an accountant when they should. Some firms are not submitting qualified reports to us when they've received one. We're also seeing some quite significant delays in submission, which obviously reduces the value of those reports to us. So we've decided, as part of the Consumer Protection Review, to launch a survey of firms, which will happen in January, and we're looking to survey 600 firms who hold client money at that point, and to get more of an idea about whether there are issues. And one of the things we'll be asking is to those firms to submit and upload the latest AR1 form to us. And on the back of that, we may go back to some of the changes that we make some changes that Ian alluded to there. We might go back to all firms submitting reports to us, whether they're qualified or not. We might ask firms to make a declaration that they've had a report when they should have done. But we'll get those results analysed. Probably there'll be a 4-week window in January, so probably looking at February, March, April time when we'll realistically come out with the findings from that survey.
Thanks. I think that'd be really interesting to see, because as you say, the numbers have gone down quite a lot. So definitely be one to watch for. So Ian, many firms will see having an accountant's report as another cost, another bureaucracy. So perhaps you could explain what the benefits are of a law firm from having a firm of accountants give that independent look at the client account.
Well, yeah, obviously, I can't be completely impartial on this one. I think there are plenty of benefits from firms having a reporting accountant. Peace of mind clearly is a big plus for a lot of firms. Obviously, we can't see all things. The reporting accountant isn't going to see all things, but hopefully it's enough of a deterrent for those potential bad actors to know that we are there, we are looking at what's happening. Now, the COFA, from experience, they don't always tend to have a strong financial background. A lot of them do, don't get me wrong. There are a lot of really good COFAs who have been in a financial background for a long time, but there are also some COFAs that don't have that. So it's helpful to have a second pair of eyes across systems and processes. And the review of things such as the breaches register that we carry out. Now, again, that gives comfort to the COFA that they're picking up the right sorts of issues, they're coming to the right sorts of conclusions, and it's also helpful to have somebody there to give them advice on how to prevent future breaches of the rules. Management letters, the non-statutory management letter, that's the thing that a decent reporting accountant should be preparing. They're the things that, or they're the reports that give background to those perhaps not so serious breaches, those things that don't necessarily qualify to go on the accountant's report but need bringing to your attention anyway. Having that management letter, it's really useful to highlight the minor issues that could have been missed by the COFA, might not have made it onto their breaches register, but those sorts of things that, if they're not checked, could develop into something a little bit more seriously. And having that second pair of eyes, I find it helps COFAs have difficult conversations with the partners, other partners in the firm, helps unlock some of those ingrained ways of working, those things that, well, you know, we've been doing it like this forever. Why should we change? Well, having the reporting accountant saying that's what you need to do, this is why you need to change, that can sometimes help unlock some of that bad behaviour. And then taking that a step further, sometimes having the view of the reporting accountant can amplify a message to fee earners. And just taking an example of something I've been involved in recently, residual balances, classic issue, impacts most law firms to some degree. But a firm that I was dealing with was really struggling to get on top of them, and it's because the fee earners just weren't listening. They weren't towing the line, basically. But getting us involved and having us as almost the bad guy, you know, we're the police. If the reporting accountant says you've got to do it, then you've got to do it. So it just helps amplify that message from the finance team, break down those barriers if they're struggling to get that message across. I think the ability to demonstrate improvements over time from those management letters that we're putting together, that can be a strong message to give to the SRA, you know, if there were to be an investigation, for example. So showing a direction of travel that says, yes, I'm acknowledging these issues that are being raised in the management letter. You know, we can't deal with them straight away. We can't deal with them all at once, but we are moving in the right direction, and we can see a clear progression towards compliance over the course of, say, 1, 2, sometimes even 3 years. That can be a powerful message to send. And of course, being a second pair of eyes on the finances generally, it's sometimes a good opportunity to spot areas that aren't being done properly. Other things like VAT is a common issue that crops up when we're looking at bills. Firms getting VAT on their disbursements wrong. Absolute minefield. I get it. Most firms get it wrong from one time to another. But having the reporting accountant there to just pick up those other, perhaps non-SRA accounts rules compliance issues, but just give people a steer in the right direction. That's really, really helpful. Just the final point I want to make on this one is remember that the reporting accountants aren't necessarily the baddies. However, we're sold to the fee earners or the other partners, we're not there to be baddies. We're there on the side of the law firm, and you know, genuinely, we do want to help firms get better. We're not just there for box ticking. You know, we really do want to help people improve.
Excellent. Your accountant is your friend. Thank you. Thanks for that, Ian. So, Mark, in terms of what you're seeing with firms, are you seeing any particular issues, maybe with new firms that you come across, or other things that you're seeing out there?
Yeah, so to be honest, we do see a number of issues with newly formed firms that come to us for our services. So they could perhaps be US firms that are setting up in England and Wales for the first time. It could be individuals that have gone off to set up their own practice after coming out of a larger firm, and they haven't considered all of the compliance angles. They may not realise they need to obtain an accountant's report. They may not be aware of the exemptions if they've breached them. I have been aware of examples where people have thought they were exempt because they were holding sanctioned monies, so they thought that didn't count towards your average reconciled balance of 10,000. So it can be quite challenging for people to realise all the angles they have to think about when they're setting up. So it does tend to be newly formed firms that we see those things at. We do also see firms that effectively bounce in and out of the exemption criteria. So they could have a series of smaller matters that are ongoing, and then suddenly they have a big matter that peaks every couple of years. So we can see them slipping in and out of the scope of the requirement to get an accountant's report. So they need to just keep monitoring that. We don't really seem to see many issues with firms submitting their reports. So we tend to get involved in that process. Obviously, the firm has to submit an AR1 if it's qualified via their MySRA portal. But we don't tend to see any problems with or reluctance of firms to submit those. I think if we did, we'd probably be speaking to the SRA directly anyway to let you know that we'd found something. In general, it feels like finance teams were a little bit more busy than they were perhaps pre-COVID 5-6 years ago. And that is predominantly driven not necessarily by the day-to-day work, but there seems to be more project work ongoing. IT systems, finance systems are coming to the end of their life cycle. So there are some quite big project teams that are ongoing, which is taking resource away from the day-to-day operations. So it's quite important for firms to realise that the underlying work is still there. Whether or not you can get some technology to assist with that would be something to think about. Perhaps I was on a session with you at LegalX this morning talking about AI, so there's some potential there maybe. And finally, in terms of people, there seems to be a bit more movement around the sector. People seem to be moving around firms a little bit more, and people are actually starting to retire as well. So there's people we've worked with for a number of years are starting to leave the sector. So firms do need to be thinking about their succession planning for their finance teams, and remembering that each firm, you've got the underlying element of legal finance, but there are still bespoke elements to every firm. So someone can't just join a firm on day one and replace someone that's got 15-20 years experience. So it's just important for firms to think about that succession piece.
Great, thanks, Mark. And perhaps back to you, in terms of when you're doing your work, how often are you qualifying reports? Maybe sort of percentage-wise, what percentage are you qualifying, and what are the most common reasons for those qualifications?
So I think it's quite hard to put a specific percentage. If I take a step back, it would probably be about 5% of the reports we do each year, and it can go up or down depending on specific circumstances. And we tend to find quite specific breaches of the rules rather than systemic breaches where firms have got significant systemic failures. It tends to be they've perhaps failed to obtain an AR1 in the previous year and they worked because they thought they were exempt and they weren't. Our good old friend banking facilities, residual balances, and we've had a few instances of unreplaced client shortfalls over the past few years as well, where firms haven't taken the right steps to do what they should have done. And obviously you released the warning notice relatively recently, which sets it out, which is quite a nice reminder for firms actually, and we've made a point of reminding our clients that warning notice is now there to remind them of what they need to do.
Excellent, thanks. And we'll come back to some of these things, I think, in our questions. So, Sean, what do we do when we at the SRA get qualified accountants reports submitted? What's the process?
Yes, so every single qualified report we get through is reviewed by one of my team in the forensic investigations side of the SRA, and they'll then decide what course of action is necessary. It's either no further action, we could do some sort of desk-based investigation, we could go out on site to see what's happening at the firm, or we could, and we often do with residual balances, make a referral to our ethics team for them to engage with the firm to try and seek a waiver to make payments out to charity for balances over £500. So there is a human input on every single report we receive.
And in terms of the themes that you're seeing, are they similar to the types that Mark has identified? What do you tend to see mostly?
Yes, I'd say the big two we see are the banking facility breaches. So there's Rule 3.3, but probably the biggest one is around residual balances. And it's probably worth mentioning now that the survey I spoke about earlier with that we're going to do in January, there's 600 firms, as well as asking about whether a firm's had an accountant's report prepared. We'll also be asking them about residual balances and how many they've got, what processes they've got in place to check them, what's the biggest amount, how many they've got. So we're trying to get behind exactly what the issues are on the ground to inform our consumer protection review, because we realise this is a high risk area for firms who hold client money. Other things that we see on the accountant's reports are things like lack of reconciliation sign-offs on those client bank reconciliations. We see unresolved differences being carried forward for a number of months, which we wouldn't expect to see in a firm that's got good controls in place. And we also see issues around the use of suspense accounts, which can again be a high risk area if those suspense accounts get too big or out of control. They can be scope there for misappropriation of client money as well.
Thanks, Sean. And I wonder if, I'm sure it's not all doom and gloom out there. So I'm wondering if we can think maybe, Mark, in terms of some areas of best practice you might be seeing that you could share?
Yeah, of course. I think the most important thing we see at the best managed firms is a top-down view that compliance is key to the firm, and it's given the importance that it really, really deserves. And that can be from having solid and well-founded training for the code for the FD, making sure the roles are given to people who are very senior within the firm that have the right authority and gravitas to challenge things that are going on within a firm. More and more firms are building dedicated support teams, so that can be for their AML, their residual balances, their general financial compliance. Good, well-documented breaches registers, rather than a firm presenting us with an A4 page that's blank and said we've not had any breaches this year. No firm has no breaches. It's not realistic. And when firms are maintaining those breaches registers, keeping good documentation of the judgments applied as to whether a breach was or wasn't self-reported, why it was or wasn't, and any thoughts, any consultations that the COFA may have had through that process. Good file closure procedures, making sure that firms close files as quickly as possible, monies are returned, and tying into that is sound residual balance management. So again, like Sean said, firms that have a process, they have a story almost of how they deal with the residual balance, is a life cycle of them. And where we do see firms that are merging or acquiring firms, they are doing due diligence on the client accounts of the firms that they're working with and merging with. so they know they're not inheriting somebody else's problem. So I think it's the compliance culture that builds a sound environment, really.
Excellent, thanks. And as you say, very much top down. That's really good to hear. Thank you. So I think all of you have touched on Rule 3.3, use of client accounts as a banking facility. It's something that has been a cause for concern and comes up always when we run these sessions, and has been a cause for concern for a number of years. So perhaps I'll start with you, Mark, in terms of how you're advising your law firm clients when they have concerns in this area.
I think it's still a grey area, and it's really important that firms do consider why something should pass through their client account, why it can't go through another type of bank account, why it can't be processed a different way. The case studies are there, but sometimes there isn't a clear comparison, or you can draw parallels, but you can't draw direct comparisons, and it's quite important to think about everything on an individual basis and don't attempt to try and pigeonhole things in, because you can draw parallels that perhaps we as the reporting accountants wouldn't agree with, perhaps that you as the regulator wouldn't agree with. There is a bit of it's a contradiction almost when firms are trying to protect client money, but that will then put them in breach of the accounts rules. So it's challenging firms as to why they believe they're acting in their client's best interest by doing what they're proposing to do. I mean, the thing we suggest to everyone, speak to your reporting accountant. If you can't reach a conclusion internally, we don't bite. We're quite nice people deep down. Having worked with Ian in the past, I can vouch for him as well. Speak to the SRA's ethics line. It's there to help. Sometimes your reporting accountants may be willing to act as the conduit for that conversation if you don't want to put your head on the block effectively and say, this is what we're doing as a firm, or we want to do as a firm. Speak to your reporting accountant. They may be willing to field it through their email addresses. But really importantly on banking facilities for us is scope creep, and some of the challenging conversations we'll have with clients are formed around, you'll have an underlying engagement, but a client will then say, can you do this for me? Can you do this for me? Can you do this for me? And all of a sudden, a conveyance that is obviously quite clearly permissible within the rules, you could well be dealing with the garden shed at the bottom of some land, and that may not be in line with the original engagement or allowable under the accounts rules. So it's making sure you understand the transaction, why you're doing it, and why it's permissible. And again, documenting any judgments that the COFAs or firms may make and reaching their own judgments.
Great, thanks. And Ian, are the ICAEW providing any guidance or support to their members in respect of Rule 3.3?
Yeah, we will be. Certainly, thanks to Axiom and the consultation. It's probably a really good opportunity for us to refresh all of our guidance generally. But 3.3 specifically, like Mark said, real grey area for a lot of people. The new case studies that came out in March last year, we're going to have to signpost those. But there are some other areas that we're considering that aren't in the current SRA case studies, and that we'll be speaking with the SRA about in due course. So things like transfers between clients, so where, say, company A lends money to company B, under what circumstances that sort of transactions permissible, and the red flags that we need to be looking out for. So we'll be looking at sort of beefing up guidance, not just the SRA's but our own on that. Things like solicitors undertakings to pay costs to third parties. Now, I know that's touched on in certain areas of 3.3 in the case studies, but there are some other situations that we think probably need to be considered as well. So there are some of the existing case studies that we might like to see tweaked a bit. So the divorce one, we feel might be ever so slightly contradictory in some cases, and could lead to a few headaches with firms. So we're going to ask for a bit more clarity on that, and some of the other general grey areas in there as well. So we will be putting out guidance. Is it ready to go now? Probably not, because it's still a bit of a moving target, and we'd want to tie it in with the general refresh that we're doing and everything else that's covered, that needs to be covered, because everything that's been going on. So yeah.
Thanks, Ian. And yeah, there is a lot going on, that's for sure, this year. So, Sean, both Mark and Ian have talked about the case studies, but what other assistance does the SRA provide?
Yes, well, it's just worth mentioning with the case studies. They are real life examples. Where we've seen people get into a little bit of trouble is to try and shoehorn their own individual cases into those case studies, because that's not always the best way to do things. They are summaries and guides to try and push you in the right direction, but not all the facts are included in them. So we do keep those under review, and it's interesting to hear Ian say that those areas where additional guidance might be required, as some of those are on our radar already, and we've been speaking with the Law Society about those actually as well. So we're constantly considering what areas we need to provide additional guidance on. Our ethics team feed into that as well, and they are a good point of contact if you've got any questions around compliance with the rule, and they pick up new themes from the calls that they receive. One of those is more recently around special purpose vehicles, where a company set up for a particular transaction, and quite often in those cases the firm or the SPV doesn't have its own bank account, and that doesn't become clear until the transaction's ready to complete. So what we really then firms end up paying money to related parties or directors, and that can then mean that they fall foul of Rule 3.3. So it's important for firms to ensure at the start of the retainer that they are clear with their client that they need there should be a bank account in place if there's going to be money movements between parties. But the real challenge where we find firms falling foul is firms wanting to be helpful. So they're wanting to do something for the client that saves them time, but really the firm needs to consider why they're making payments, and if that's part of the regulated legal services that they are providing to them. So being helpful is nice, but be aware of your regulatory requirements as well.
Great, thanks. So I'm going to come to questions soon, but maybe just a couple more to finish off. So your FI team, your forensic investigation teams, go out on site to firms right across England and Wales. And I just wondered if you're seeing anything of significance to draw out, Sean.
Yes, just a couple of things before we get into the questions. Is AML concerns are still a big issue, where firms, with that's a fast-moving area, the money laundering regulations. So firms need to be mindful of any changes and make sure they keep up to date with those and on the right side of the regulations. And the other big thing we're seeing at the moment is firms who are involved in bulk litigation work. So people will be aware of what happened with SSB, a firm up in Sheffield that failed last year and left a lot of clients in difficult positions with adverse cost orders. And we're looking at a number of different firms who do that type of work, who may potentially be leaving their clients exposed to costs or loan liabilities, and perhaps aren't acting in their clients' best interests.
Excellent, thanks. So I'm going to move to questions because they are coming in thick and fast. So let's start with, I've got one here from an anonymous one actually here saying, on completing a property sale, we have £50 left on the client account. The client instructs us to donate the £50 to charity. By doing so, do we risk breaching Rule 3.3? Sean, do you want to take that one?
Yep, happy to take that. That probably touches on my comment earlier about trying to be helpful for clients. So that's not part of your regulated legal services. The best thing to do in those circumstances is to repay that money back to the client, and they can pay that money to charity if they wish. So it wouldn't be the most serious of breaches with a £50 payment, but that's not something that a law firm should be doing.
Lovely. Thanks, Sean. I've got one here from Sophie. I'm setting up my own firm because I'm good at my job, but maths was never my thing. So the account rules always daunt me. Where do I start? Will I survive? I'm sure you will. I'm sure you will, Sophie, and hopefully that you've had some guidance today. But perhaps, Mark, shall I hand over to you for that one?
Thanks, Liz. I think, don't worry, they are not as daunting as they seem at first. My advice to you would be get the right support in place from the outset, get the right system for you and your firm. And if you need to, even though it may be an expense at the start, get a third-party cashier and company to help you as well. We see so many firms that have set up, and it can take 12 to 18 months before they even realise there's a problem, because they're just plodding along doing their own thing, and they haven't realised they need to be doing client account reconciliations. Some of them haven't necessarily realised they've breached the exemption thresholds to get an AR1. So surround yourself with a good team at the very start of your firm would be my advice, and continue to attend events like this where you can pick up advice and guidance and ask questions of people. People are very happy to help.
Lovely, thanks. Sean, did you want to add anything to that?
Well, I'd say good luck to you starting your own firm. I think attending something like this is a real good place to start. It shows that you're wanting to get up to speed with the requirements of the accounts rules. They're not actually as daunting now as they used to be. The 2011 rules were much longer. I would say use the SRA website as a good source of information. There's lots of guidance on there and warning notices, and also our YouTube channels, another good source of information where you can look at previous webinars that we've done or sessions like this to just show what the common themes or pitfalls are that we see on the ground regularly.
Excellent. Thanks, Sean. I've got a question here from Sharon Lilly. Sharon has asked, we have a number of trusts where we build for, but the company where the funds are invested charges a significant amount of money for every withdrawal. This leads to our bills not getting paid. If we were to withdraw one amount that would cover our fees for, say, 1 year and hold this in client account, would this be breaking the rules for providing banking services? Probably for you as well, Sean, I think.
Okay, yeah. Well, we allow payments on account of costs and for those to be retained in client accounts. So it wouldn't be a breach of Rule 3.3. I think the main thing to establish with your client is that they are happy for you to do that. So you agree that upfront with them and get the authority to be able to do that. But it makes sense if you're not incurring those charges for the trust. The money's held securely in client account. So I don't think Rule 3.3 is an issue. It's just making sure that the client is aware of that and they consent to that at the outset.
Great, thanks. Right, perhaps I'll bring in Ian and Mark now. So I've got a question here from Alison. How long can monies be held, for instance, a probate client with monies coming in from dividends periodically? Ian, did you want to pick that one up?
Yes. Okay. It's quite daunting having Sean sitting right above me and and answering questions on the accounts rules. So how long can monies be held, for instance, a probate client with monies coming in from dividends periodically? Well, I don't see there being a particular problem with holding the money in the client account for relatively short periods of time. I certainly wouldn't want to be holding the money in there for longer than necessary, especially if they can be paid over to the client. I think what we wouldn't want to see is the client account sort of ending up being a bit of a dumping site for small amounts of money. just coming and building up until they reach a level, a sort of undefined level that's acceptable for the firm to decide that it's then worth paying over. Because I don't think that would be acting in the best interest of the clients. What do you think, Mark?
I think I agree with you, to be honest, Ian. It's as long as it would be accepted as the matter's progressing. So if you're making periodic distributions to beneficiaries, say once a quarter, as that matter's progressing, then retain it until the next distribution's made. I wouldn't say if you get a £5 dividend in, you've immediately got to distribute that between however many beneficiaries there are upon receipt, but just don't retain it any longer than you actually need to. And then make sure that once you've concluded the estate, you're no longer acting for that on that matter, that you no longer receive those dividends. So if the shares haven't been sold as part of the estate resolution, make sure the bank beneficiary details have been changed at the share dealer.
Excellent, thank you. Sean, I assume you're happy. I see you nodding. So
it's just Ian doesn't need to worry about me. But it makes complete sense. I mean, it's as long as the legal service continues to be provided by the firm in respect of that matter, then you're going to be all right. And what Ian and Mark have just said there makes perfect sense.
Excellent, thank you. So I've got a question here from Barry. Do we need to get SRA permission to pay a residual balance of more than £500 to charity if a partner in our firm is an executor? I'm going to look for a hand. Someone just show me if you want to take this one. I think you could all answer this, or a nod. Go on, Ian, then. Over to you. Thank you.
Yes, yeah. I don't think having a partner being an executor bypasses the requirement to get SRA approval. I could see why, if the balance was under £500, that there might be an argument to say that you don't necessarily need to get approval from anywhere else within the client relationship. But I'd say over £500, yeah, it's down to the SRA to decide. Sean?
Yeah, I'd agree with that. So our ethics team are there to give waivers for those sums. So it's not too onerous to do, and everyone can protect themselves by going down that route. So that's what we'd suggest in those circumstances.
Great, thank you. I've got a question here from Gail. Can some guidance be given as to what amounts to reasonable attempts to trace the recipient of funds on aged matters? For example, in terms of time, effort and cost, especially in relation to the actual sums held? Sean, you're nodding a little bit there. So
I'm happy to. It is very subjective. It depends on the amounts involved. So we wouldn't, for really small amounts, we wouldn't be expecting firms to expend a great deal of time in trying to trace those matters. The important thing is to make sure you fully document what you've done, what the challenges are, what steps you've taken to try and trace clients or make contact with them or get their bank details. And if you do make payments out to a charity, you get an indemnity from them, so that if that client does at some future point say, I'm here now, where's my money, you're able to then recall that effectively from the charity and make that payment to them. But an audit trail is really key to show your decision making and what efforts you've made here.
Great, thanks. I've got one here which is a little bit similar to one we were asked a couple of weeks ago. So this is one from Maria Moore, who has asked, we agreed fees with our clients for each stage of work to be done, excuse me, and then for each stage of work to be done and then invoice the client prior to carrying out the work. The agreed fee is fixed. If we instruct an expert or barrister, we obtain a fixed fee quote, agree it with the client, and then invoice the client before the work is done, so we have the funds to pay the third party. Are the payments received from the client money or office money? As the Rule 2.1D definition of client money refers to fees and unpaid disbursements received prior to a bill for the same. There's no reference in the rules to agreed fees or invoicing in advance. Sean, I'm going to give that one to you. I think we had something a little bit similar in the face-to-face conference.
Yes, we did. So, and I'm sure Ian and Mark will have their thoughts on Rules 2.1 as well. So, there's no agreed fee definition in the current rules, as there used to be in the 2011 rules. What we're saying here is you need to agree with your client on an individual basis that the billing arrangements here, any disbursements that the firm are liable for, it's fine to invoice those in advance and take that money into the firm's business account. But clients need to be aware of the risks involved in the firm accepting money into the business account on those terms. So you need to, as long as you're upfront with the client, explain the risks and that the amount you're billing for is reasonable and the fees effectively will cover that tranche of work that you're about to undertake. I mean, this happens quite a lot in immigration firms that do immigration work, where they would bill in advance to get the matter to a particular stage, which is understandable and completely acceptable. Obviously, it does lead you to then having to account for VAT at the outset before you've undertaken that work fully. But again, I'll bring in Ian and Mark, because they'll have examples of this in real life.
Ian and Mark, anything to add?
Yeah, I think again, gosh, it sounds like we're deliberately agreeing with each other, but yeah, I absolutely agree with everything Sean said there. The difficulty from a reporting accountant's perspective is around how much exactly clients are being told around the risks of holding on to this money. So just picking up that point that Sean said, how important it is if money is being held in the office account before any payment of these disbursements, for example. And the difficulty for us is verifying that they have told the clients as much as is required in the rules. And actually, I think 9 times out of 10, we can't get satisfied, and it becomes a challenge for us. So it's a really, really difficult part of the rules to be compliant with, I think. A lot of challenges there.
Thanks, Ian. I'm going to move on. I've got a couple of ones which are probably putting you on the spot again, Sean, I think. So I've got one here from John Hosey. We keep seeing law firms acting on the other side of a corporate transaction who claim often at the 11th hour that they don't have a client account. So the money from their client will need to be paid directly to us. Does the SRA have any comments on this, how the firms are acting in the best interest for the client, for example, and whether this is acceptable?
Yeah, it's this is one of those areas where I spoke about trying to get the banking movements and who's got bank accounts sorted at the outset of the retainer, and it often happens then at the 11th hour, and you're not wanting to jeopardize the proper completion of the transaction by not doing something like that. So it is difficult, but you've got to be mindful of, if you're paying money out, who that's going to and whether they are party to that transaction, and making sure that there are no red flags in making those payments. And again, I'd refer to the guidance we've got and our ethics helplines as well. And again, probably Ian and Mark may well have seen these types of transactions and then have to decide whether or not to report them as breaches on their AR1 forms.
Mark, Ian?
Yeah, I mean, I don't necessarily see a huge 3.3 breach here because the firm would be acting on the transaction. So there's a clear connection between the fund flow and the provision of legal services. But it's whether the firm are comfortable, they've done their own source of funds checks on those funds, they're comfortable, they're coming from a legitimate source, they're not placing the firm at any wider regulatory risk outside of the accounts rules that they need to be considering over and above the 3.3.
Great,
Yeah.
thanks, Mark. Sorry,
just to add into that's where there's a real danger of scope creep for us coming in, because we do find ourselves asking questions of firms as to whether they've done their source of funds checks, the AML checks that are necessary. And actually, is that the responsibility of the reporting accountant, given that we are there specifically to report on breach of the accounts rules, not necessarily the wider AML issues. So again, that's a challenge for us, and we probably, it's an area that we probably wouldn't want to get too involved in, other than saying, does it feel like a breach of the rules? If so, then we make our own mind up about reporting.
great, thanks, Ian. I reckon I can probably squeeze a couple more questions in. So I've got one here from Helen. In a probate case, we've received the funds from the bank accounts but have a house to sell. The estate is divided by percentages. Is it okay to hold the bank balances until the house sells, or should we do an interim distribution? Who'd like to take that? Sean, I'm afraid you'll be my fallback then.
No, that's fine. That's fine. No, I mean, no, it's clearly it's part of the regulated legal services that's being provided. It doesn't become a residual balance if the firm want to collect in all those assets and then make the distributions at the end. Then that's fine. I just say, with if it becomes more protracted and the matter's not going to be completed for a long time, then you perhaps contacting beneficiaries and looking at making interim distributions earlier than you may have otherwise anticipated.
Great, thank you. And perhaps I might be able to squeeze two in, but we'll see. Romana asked, we do not have a client's account and do not plan on opening one. We only accept ours, councils or court fees on a pro forma invoice into our business account. We pay councils or court fees right away once the client pays us. We also ensure we explain to the client what's going to happen when they agree to this. Are we doing the right thing?
Let me take that one again, Liz.
Yeah, go on.
So,
go on.
Yeah, that sounds like they're covered by the exemption in our rules to not have to have a client account. It's the disbursements are ones that the firm themselves are liable for, and it's the only other monies are for the firm's costs. So that's fine not to operate that through a client account.
Lovely, thank you. I'm conscious of time, and there are a couple more questions, but I have done the vast majority, and the couple more questions are quite complicated. So I think I'll probably close it there and say sorry if we didn't get to your questions, but point out there is quite a lot of guidance on our website, and there's resources that go with this. Also, we talked about our ethics helpline and other things to keep an eye on. And I'd like to also use this opportunity to flag again the Consumer Protection Review webinar, which is at 1:30. So you've got time to grab some lunch and get back for that one. Or of course, you can watch it again on YouTube at a later date. But there's quite a lot of linkage between the subjects. So do take a look at that. So all that remains is me to thank our panelists. Thank you to Sean and Mark and Ian for their time today. I hope you found it useful, and I hope that that we've got to most of your questions. Please, could you give us some feedback? It's really important to us to get your feedback. You'll be able to click on the link below the video. It'll only take a minute, and it really does help us to improve what we offer to you. So again, thank you for your time. Thank you for listening, and enjoy the rest of the compliance week. Thank you.